Hi to everybody. So I hope you can hear me. All right, so I'm very pleased to welcome our so-called lunchtime speaker today. This is the name we used to give to the speaker at this point when we had the normal live conference. Today's speaker is Rick Faery, Managing Director at Credit Suisse. Credit Suisse is one of the founding sponsors of the M&A Research Center, therefore working with us since 2009, and we are very thankful for their support over these 12 years, working together on many research reports and publications. Rick is a global head of the Corporate Insights Group within Credit Suisse Investment Bank division, providing the firm's clients with bespoke strategic advice on corporate strategy and M&A, equity market valuations and offerings, capital allocation, and financial policy. Rick and his team write and publish Credit Suisse Corporate Insights, a periodic series that examines market themes and topics of interest to corporate clients. Rick has more than 2 decades of experience in strategy and corporate finance advisory with clients in the US, Europe, and Asia, including 3 years with Deloitte, both in New York and in London, and 19 years with Credit Suisse in London and in New York. Rick holds graduate degrees in law from Syracuse University and in finance and economics from Columbia University. Rick, I don't see you, but I think you are here joining us from New York. Thank you for joining us. And I think without further delay, I would like to give you the platform. The platform is yours. Thank you. I see you, Rick. Thank you for joining us, and the platform is yours.
Great. Thank you very much, and thank you all for having me. Apologies for the earlier tech difficulties. Just want to make sure that my colleague Marcus, there he goes. Yeah, okay. Can you do the full screen? There you go. Perfect. Thank you. So again, thank you all for having me. I really appreciate the opportunity. We at Credit Suisse certainly value the partnership with
Rick. I'm just coming in. Marcus, can you hit display settings in the upper left, because we're seeing the dual screen, and then if you exactly click that. Perfect. Thanks.
Okay. I was saying we at Credit Suisse certainly value the partnership with Scott and team that we've enjoyed over many, many years, and looking forward to continuing it. For my part, I've been listening to some of the presentations this morning. What we do is certainly far more simplistic, I think, than a lot of the math-heavy stuff that we've seen this morning. But I hope you'll find it interesting and valuable, because it does come from the perspective of a group of people who work in an investment bank. We spend our days, nights, weekends talking to corporates around the world about M&A, how to think about it, why it's helpful and useful, why it's important, and it's a very pragmatic approach that we've taken to some of the work we've done. So, Marcus, if you'll flip to the next page. Thank you. So as you heard in the introduction, one of the things that my team and I do, in addition to spending a lot of time talking to CEOs, CFOs, heads of M&A, boards of companies around the world about strategic issues, is we spend time researching and writing a whole series of papers that we've been doing for about 6 years now. And in the course of these papers we've done, all of which I should add are publicly available at the website at Credit Suisse, we've covered a whole variety of topics. Capital deployment. One of my favorites is the second paper we did called Managing the Multiple, because it really gets into the weeds about most corporates' favorite question, which is, I trade at 10 times, my favorite competitor trades at 15 times. That makes no sense. So it gets into the weeds about what a market multiple really means. We've done a couple of papers on activism, on financial policy and dividends, on growth, on surviving difficult periods of time like we've just seen in the past 18 months plus. And embedded in a bunch of the papers we've done is the theme of M&A. So we've done at least 4 or 5 papers rather now that have touched upon M&A as an idea and as a viable strategy for corporates to pursue. And my materials this morning are really pulled from these papers and the insights we've gleaned from conversations with corporates around the world. So if you go to the next slide. So let me take you on a bit of a journey here as we get towards the theme of M&A. One of the core principles that we as a team, and frankly we as a bank, believe is really important is the notion of returns on capital. Returns on capital are a key driver of market valuations. As you can see from the graph here on this page, this is the S&P 500 and the FTSE Eurotop as of last month, or this month rather. And if you do a correlation of expected return on capital spread for all the companies in those markets relative to a price to book multiple, you get a pretty high R squared, 65% in this case. Depending upon the industry that you look at, I've seen R squareds on these analyses go as high as 90%. So what that tells you is that there is a lot of explanatory power in market valuations on a price to book basis when you look at returns on capital. The higher the return on capital of the company, the industry, the higher the price to book multiple in general should be. But as you can see from the R squared, it's not a perfect fit. There's other things out there which do a lot to explain why valuations are not solely about returns on capital. Next page. And in general, our belief is that the biggest portion that's not explained by that correlation you just saw is growth. So if you look at the left-hand graph on this page, this is the same markets, and we're looking at the return on capital spread on the x-axis. It's the same x-axis from the prior graph. And now we're comparing all those companies in terms of the returns of capital to the sell side's view of top-line growth. And what you see when you do this kind of analysis is that companies kind of fall into various buckets from a valuation perspective. So the quadrants here are defined by median returns and median growth, and then we're observing the current valuations on an EBITDA basis of the companies that fall into those quadrants. It's very clear that the businesses that have the highest multiples on average in the market are those that we're labeling here outperformers. They're on the top right quadrant. They have better than average returns on capital, and they're growing more quickly than most other companies in the marketplace. They are on average right now trading at about 21 times FY2 EBITDA. And that is an 11-turn premium to the companies that are in the bottom left, which we're calling underperformers, which are currently trading at about 10 times. So the market clearly looks at, thinks about, and responds to stories of high returns of capital and fast growth. The observation that we're making here on the left-hand side of this page is it's not a once in a lifetime thing. It's happened persistently over long periods of time. If you look at the graph on the right-hand side of the page, this is showing you the multiples of the top right quadrant versus the bottom left quadrant over a long period of time, going back to actually before the financial crisis in 2008. And what you see is at every point in time that we've looked at, companies that have better than average returns and better than average sales growth expectations trade at a premium to the rest of the marketplace. That happened during the depths of the financial crisis. And really interestingly to us, during the market sell-off in March of last year, even then, there were companies that were trading at a premium to the rest of the market because the market still had more robust expectations about those companies' ability to drive high returns and fast growth, even during the pandemic sell-off. Next page. So one of the things that we believe is true, and we've heard people talk about competitive advantage over long periods of time, is that you can actually quantify competitive advantage by looking at returns on capital. We did a paper a few years ago looking at that very idea that you can quantify competitive advantage by defining businesses which trade at a substantial premium. Businesses which generate returns of capital that are at a substantial premium to the industry average. And what you see on this graph on the top left of this page is that we sort of split industries and companies into cohorts. Companies that had a notable premium return on capital performance relative to the industry. That's the companies that are in Group A. Group B are companies that are still above the industry average, but closer to it. Group C are companies that are generating returns on capital that are in line with the long-term industry average. And Group D are companies that are actually generating returns below the long-term average of their own industry. So what? So what if companies are generating high, middle, or in line with or below performance on a return on capital basis? Well, it matters. It matters because if you look at the TSR, the total shareholder return, or the stock price performance relative to the index, what you see is that companies that have better than average returns on capital over time are those that generate a higher TSR over long periods of time that we've looked at. So what that says is that you can quantify competitive advantage by looking at returns on capital, and companies that have that stronger competitive advantage tend to perform, or tend to outperform rather, companies that don't have that competitive advantage. Next page, please. And what we've seen is that if you've got a business which has a sustained and improving competitive advantage, what that says is that these companies outperform over long periods of time. Sustaining and improving your competitive advantage, sustaining and improving your return on capital advantage relative to your peer set means you should be enjoying higher and higher and higher TSR relative to the rest of the market, relative to your peers, relative to your industry. Conversely, if you have a deteriorating competitive advantage, your returns on capital are falling below or falling towards or below the industry average, you see negative TSR as a consequence. Now I'm going to circle back now to the M&A topic on the next page. Why did I bring up competitive advantage? One of the things we wanted to do after we'd seen this analysis that showed that businesses with competitive advantage outperform over long periods of time, we wanted to understand what was it about these businesses that was maintaining or improving their returns on capital over long periods of time. How do they maintain and improve their returns on capital? Well, what we found was that the companies that are sustaining and improving competitive advantage spend money in a different way than companies that are seeing a deterioration in competitive advantage. So if you look at this graph, what you're seeing is the average capital spend in millions of dollars per year for each company in the time period we were looking at. So companies that were sustaining and improving competitive advantage were spending quite a lot on organic investment, CapEx, R&D, operating intangibles. They spent, actually, interestingly, almost 3.5 times more on M&A than the companies that were competitively disadvantaged. And they spent about the same on divestitures. So overall, there was more capital being spent on businesses that were driving competitive advantage in the marketplace. And the M&A point really interested us. I should also point out that when we did this analysis, it surprised me that the divestitures number was almost in line with. I would have expected that companies with competitive advantage were doing more about pruning the portfolio than the numbers we looked at proved out. But the M&A point is one that I want to explore now with you guys here today. So again, 3.5 times more in M&A. So M&A and portfolio activity, as you saw from the prior page, can drive competitive advantage. And I would submit that even the current environment that we're in right now is continuing to be supportive of those kinds of stories. This graph here just shows you the M&A deal volume and announced transactions on a dollar basis going back to the mid-1990s. There was a big M&A peak around the 2000 dot-com era. There was another big M&A peak right before the global financial crisis. There's been a prolonged period of M&A activity since about 2014, 2015, bit interrupted obviously during the COVID crisis. So it's a large time frame, longer than we've seen for prior M&A peaks. It hasn't yet got to the peaks that we saw right before the financial crisis. And of course, we've seen the tail off during the COVID period. But what I would say is this robust period of M&A activity is broadly being supported by three things. One, a persistent level of weak organic growth. Two, access to capital, easy access to capital. And three, I would still submit, despite the valuation multiples we're seeing right now, a pretty favorable hunting ground. So let's look at each of those three things in isolation. Weak organic growth. Well, that means that any growth story that you find in the marketplace should be valued pretty well by the market. If you look at the top of this page, number 8 here, we've seen that global economies have experienced declining economic growth over the last 2 decades. So you look at the US market, Europe as a whole, in general, we see declining economic growth for those economies. Obviously, there's a big downturn during the COVID period of the last 18 months. But the general trend is for declining economic growth in those markets. If you look at, that's sort of market wide. If you look at top line growth expectations for companies over that same time period, you see the same thing. Top line growth expectations have been falling fairly steadily for 20 years. Look at the bottom right-hand graph here. We're showing you a couple snapshots. The 1998 to 2000 period, where top line growth expectations were around 7.8%. By the period right before the financial crisis, it dropped to 6.1%. And in the period right before COVID hit, it had dropped again to about 5.5%. So growth expectations for businesses overall have been falling. Next page. So that was point one, that there's pretty anemic growth out there in the marketplace. So that could be a spur to M&A activity to goose growth expectations for your own business. The second point is that capital to fund M&A is cheap and accessible. I find the graph on the top of this page really impressive, frankly. It shows you two things: the total amount of cash on the balance sheets of companies in corporate America and corporate Europe. It's about $1.4 trillion right now. And more interestingly, the bottom part of that graph, those bars, show you the percentage or proportion that cash represents of the total invested capital of companies in the US and Europe. And right now, cash is about 13% of the balance sheets of companies in the US and Europe. So there's a lot of liquidity out there sloshing around. Furthermore, debt financing is really cheap, as everyone knows. Yields have been falling for 10, 20 years, and the bond yields right now, again right before the crisis of COVID, had fallen to about 3.8%. So cheap funding out there, whether it's cash or debt, to fund M&A activity. And let's move to the third point. Favorable hunting ground. So we often hear that valuation levels seem to be higher now than they have been historically. That is a bit true. I'll come back to that in a second. But I think it's also important to bear in mind that if you compare the valuation multiples to the macro background, average corporate bond yields 20 years ago, when multiples were 9.3 times, was about 7.1%. In the most recent environment, multiples right before the COVID crisis were about 11.5%, but the bond yields were only 3.8%. More interestingly, if you look at the bottom half of this page, what we see is that premiums paid to acquire businesses have actually been falling, especially in the last 10 years. So you're having to pay less of a control premium to gain access to a publicly traded asset than you would have before. And the final point about the favorable hunting ground is that investors seem to have developed a more bullish attitude towards companies engaging in M&A than we've seen historically. So if you look at, this is TSR numbers. You look at, or share price responses rather. If you look at what the graph is showing, is that the share price response has been more and more positive over the last 20 years. And I'll come back to that again in a minute. Next page, please. So the multiples. Yes, valuation multiples have been increasing, but I think if you look at these graphs on this page, they have been increasing for good reason. Multiples, going back to my very first point I made a little while ago, multiples have been increasing because the underlying profitability of the businesses that are driving those multiples have also been increasing. Look just, for example, at the top left graph on this page. This is the market over time in the US. This is comparing the expected returns on capital to the underlying price to book multiples of the companies in the US market. So the multiples have been rising, yes, on a price to book basis, but the returns of capital have been rising as well. So it's interesting to see that post the global financial crisis, the returns of capital have been rising consistently year over year over year, and they're now on an inflation adjusted basis generally about 10%. Europe is a little more anemic in terms of its return on capital recovery post the global financial crisis, but the same story persists, that multiples and returns of capital tend to move together. Next page, please. So I think I've tried to make the point here so far that returns of capital matter, growth also matters, that competitive advantage is about driving high returns of capital and growing the business, and that M&A seems to be a viable means of achieving competitive advantage and therefore higher valuations for your business. But this page 12 recognizes that M&A is just one of many capital allocation choices that management teams at companies have to bear in mind. So you can, as a CEO of a business, you can spend money on organic growth by spending money on CapEx, R&D, building operating intangibles and so forth. You can also then think about spending money on M&A. This is the inorganic growth opportunity, buying early life cycle businesses, expanding your product base, expanding geographically. If neither of those two options work, the third option is to return cash to shareholders via buybacks, via dividends, maybe delevering the business, or alternatively thinking about building cash, as we've seen that's certainly been happening in the US and European markets with that $1.4 trillion sitting on balance sheets around the world. So these are the sort of options that we think about, or the option set we think about in terms of what companies can do in terms of spending capital. One challenge for us has been to think about how do you prioritize these things. I mean, if you go back to page 12 for 1 second, Marcus, sorry. This graphic on the next page, so yeah, that one. This graph on page, or this table on page 12 shows you that there's a sort of intuitive set of choices that companies can make. And we've prioritized them this way, again, on an intuitive basis. We set out earlier this year to actually quantify whether this in fact bears out in reality. And if you look at what's on page 13, what you find is that in our analysis, next page, Marcus. Thank you. What you find is that it does actually work. So this analysis was done by looking at the value of a dollar spent industry by industry over time. We looked at about data over about 20 years, comparing the value that is gained by spending a dollar on organic growth, on M&A, on reducing debt, on building cash on the balance sheet, on doing buybacks and dividends. And we actually were able to put a dollar value on that dollar spend over time by industry. And what you see is that more often than not, for most businesses we've looked at, organic growth, as you would expect intuitively, is the most valuable thing to do with money. So spending money organically by CapEx, R&D, and so forth is the most valuable option overall for the market. A dollar spent on organic growth is worth about $1.93 for the market generally. It's much more valuable for businesses like consumer staples and healthcare, than for other businesses. And in fact, dollars spent in materials or energy is actually worth less than $1. Probably not surprising in the energy space in particular. M&A, again, intuitively to us, it felt right to think about M&A as being second to organic growth in terms of money being spent. And what we found was that was in fact the case. So M&A is worth about $1.40 for the market overall for every dollar spent. And it remains the second priority, or the second in terms of our hierarchy, for every industry except for materials, where it falls to fourth. So again, M&A seems to be a really valuable option for many companies. And again, this to us made a lot of intuitive sense. And what we did to figure out this kind of analysis was, and this is the intriguing part of our analysis, we looked at $1 invested in M&A. We were doing a net present value estimate of the announced synergies for each deal. And the unique wrinkle for our analysis was we were not looking at market prices for acquirers and for targets. We were actually looking at intrinsic value. And we found that, much to our pleasure, we found that most companies were buying undervalued assets, which is a good thing to do because it's a value transfer to the acquirers. So that's how we got to the analysis. Again, I think we looked at about 5,000 deals over a 20-year time frame to get to the numbers you're seeing on page 13. And there is an entire paper that we have just put out about 3 weeks ago, I think it was, on this work, on this analysis. So
okay, thank you so much for including our paper to the conference program. So it's really our great pleasure to present this paper and get some feedbacks. So this paper is co-authored with Sudipto Dasgupta from the Chinese University of Hong Kong and Gerald Harford from the University of Washington. And I'm Fang Yuan. I come from Peking University. So this paper is about EPS sensitivity and how that affects merger decisions. So we started this project because we noticed that earnings per share seems to be very important among the M&A practitioners. So if we do a very simple Factiva search, combining the keywords of mergers and acquisitions with EPS accretion and dilution, it gives us over 300,000 hits of articles. So in those articles, here are some frequently used phrases. People would say that a certain merger deal is immediately accretive to EPS, slightly accretive to EPS, slightly dilutive, but turn accretive in 3 years. People may also want to emphasize if a deal has no material impact on EPS or it minimizes the dilution to EPS. It's kind of interesting because EPS accretion seems to be used as a favorable portrait in terms of describing a merger deal. So this is an example. So these sentences comes from a news article about acquisition announced by this company called Buford Capital, whose stock price increased by 12% after the deal announcement. And in this announcement, it says this acquisition will be immediately accretive to earnings per share. So to us, as financial economists, we think this is interesting because there are no particular finance theories suggesting that EPS accretion has particular benefits. So in fact, mergers and acquisitions can cause mechanical changes to earnings per share. I will be more specific about this a little bit later, but here just very briefly, if we think about a merger deal paid with stock, because there will be new shares issued to the target investors, so that even though the values to the shareholders on both sides doesn't change, there could still be changes in the earnings per share. However, this kind of change in EPS has nothing to do with deal value. But investors seem to think this is a very important indicator, especially the investors on the acquired side. They seem to think EPS changes indicate their gains or losses from a merger deal. So it could make sense if one assume a particular form of stock price inefficiency. For instance, if the market believes after the merger is completed, the PE ratio for the combined firm is going to remain at the same level as the acquired before the deal, then of course EPS dilution will lead to a negative stock return. It is also possible that even though investors know deal value should mainly come from deal synergies, but the information about the synergy is usually not available to them at the time of deal announcements, so that they may rationally underweight the deal synergies that will be realized in the long run, and which is also uncertain at the time of a deal announcement, but overweight the EPS effect, which is more certain and will be manifested in the very short run. So given those background, what we are trying to do in this paper is that we want to understand whether EPS sensitivity may have any material influence on merger decisions. So there are two layers of research questions in our paper. First, we want to understand how does EPS sensitivity affect the M&A decisions. We focus on first the method of payment. We will provide some direct evidence on this. And second, some of our results will draw implications about the set of deals that are eventually done, which is also going to be affected by the EPS sensitivity. The second research question we're interested in is the economic costs. So we want to understand whether there are any distortions in terms of the acquirer's financial and investment policies when they before they announce EPS-driven merger deal. And then we are also going to look at shareholders' stock returns. Okay, now let me talk in more detail about what exactly we do in this paper. First, what do we mean by mechanical change in EPS? So we measure the earnings per share of the combined firm immediately after deal completion by summing up the earnings of the acquirer and target, and then scale by the total number of shares. So we do not have to consider the additional earnings flows generated from deal synergies, because at the point of deal completion, deal synergies would not be realized yet. The number of shares issued to target investors will affect the denominator here. In other words, the exchange ratio will affect the combined EPS over here. So from this formula, one can see that paying cash is friendlier to EPS compared with paying stock. That is because when you pay cash, there is no additional shares issued to the target investors. However, we argue that stock payment is still likely to be the default form of payment because cash deal comes with additional costs. Cash payments can incur immediate tax liabilities and sometimes also additional flotation costs associated with the debt issued to finance the cash payment, and so on and so forth. So that this would give us the prediction that if deal structures are sensitive to EPS, one would expect to see that cash is more likely to be used as the method of payment when the deal would incur mechanical EPS dilution if it were paid fully in stock. So to test this intuition, we propose a measure, which is the hypothetical change in EPS, assuming a deal were fully paid in stock. We call it the pseudo change in EPS. So how to calculate this? We first need to estimate a pseudo exchange ratio. For a cash or mixed deal, we simply take the ratio between the offer price per share of the deal and the acquirer's stock price 2 days before deal announcement. So this ratio will tell us what the exchange ratio would be if this cash or mixed deal were paid with stock. Of course, for a stock deal, the pseudo exchange ratio is the same as the actual exchange ratio. And then we use this pseudo exchange ratio to measure the combined EPS. So this will give us a pseudo combined EPS. So the gap between the pseudo EPS and the acquirer's EPS before the deal will tell us the hypothetical effect on EPS by the deal if the deal were paid with stock. We are going to scale this gap by the acquirer's stock price just to make sure that this magnitude is comparable across different firms and different deals. In terms of the measurement, so here EB and ET refers to the acquired and target earnings per share, which is measured by the median forecast of the annual EPS for the year of deal announcement. So in particular, we're going to take the EPS forecasts that were made within 180 days before deal announcements. Okay, and then we are going to use this measure, which is the standardized pseudo change in EPS, and to run a regression discontinuity design. So this pseudo change in EPS is our running variable, and the dependent variable is going to be either the percentage of cash in deal consideration or a dummy indicator of paying cash. We are going to control for higher order polynomial terms of the running variable here. And the independent variable of our interest is this dummy indicator that the running variable is negative. So according to our hypothesis, we expect that the coefficient on this dummy indicator of pseudo dilution to be positive and significant. So to put it in words, it simply means that the propensity of paying cash should be proportionally higher when the pseudo change in EPS is slightly below 0 rather than slightly above 0. Okay, so before showing you what we find, let me mention that there are two important identification assumptions in our design. First one is that we need a deal structure to be very sensitive to EPS impacts, so that even very small magnitude of EPS dilution would cause a large change in terms of the deal structure. And then the second assumption here is that we assume any factors other than EPS sensitivity should not affect the cash paying tendency in a discontinuous manner around the 0 threshold of the pseudo change in EPS. So this second assumption will help us to draw some causal inference. Our data comes from typical data sets, merger information from SDC. Our sample starts from 1991 because before that, SDC does not report very detailed information on deal consideration. And our baseline result will be focusing on the completed deals. EPS forecast comes from IBES database. And when it is missing, we will fill it up by the historical EPS obtained from SDC. Okay, so here I'm showing you the fractions of the cash and mixed deals, as well as the fraction of pseudo dilutive deals in each year. So as we can see that there has been an increasing trend in both fractions, which is suggestive that when the deal is pseudo dilutive, it is more likely paid with cash. Now, to provide more direct evidence, so here comes our main result. So the dependent variable here is the fraction of cash in deal payment. On the left 4 columns, we are showing the results coming from the using the full sample of mergers between 2 US public firms. So as we can see that the coefficient on pseudo dilution is positive and significant across different specifications. It tells us that when we compare the pseudo dilutive deals with the slightly pseudo accretive deals, the former type has a higher fraction of cash in their payment, and the magnitude is about 6 to 14 percentage points. On the right 3 columns, we zoom in on a smaller range of pseudo change in EPS around 0. In this smaller sample, we find consistent evidence. So here are some visual evidence. So on the upper 2 graphs, these are the percentage of cash. Lower graphs shows the dummy indicator of cash and mixed deals. The left 2 graphs use the full sample of deals. The right 2 graphs use the deals around a small range around 0 of pseudo change in EPS. As we can see that across different samples and the specifications, the discontinuity is strong and significant. So we also checked the distribution of our running variable. There is no discontinuity around the 0 threshold. We also checked the control variables in our regression. Except for the relative deal size, other control variables are all smoothly distributed around the 0 threshold of pseudo change in EPS. Now, so as mentioned before, paying cash can be very costly. So there is one type of cost which may directly affect the combined EPS, that is the potential interest expenses from the debt used to finance the cash payment. So one may wonder, okay, the regression before has shown that the slightly pseudo dilutive deals are more likely paid in cash, but are these cash payment really associated with a higher EPS? So here I conduct this analysis to confirm that the answer is yes. So how we do that? For each cash and mixed deal, we estimate the expected interest expenses for the amount of cash payment in this deal. So this X here in the denominator is the actual exchange ratio. So for a pure cash deal, it's going to be 0. So this is going to give us the expected combined EPS after deducting the interest expenses with the cash. So we can say that a cash payment is friendly to EPS as long as this expected EPS is higher than or equal to the pseudo EPS. Okay, so now I want to show 2 results with this measure to you. First one is that we checked among the deals that were slightly pseudo dilutive and were paid with cash, close to 80% of them are actually the cash is actually friendly to EPS. In other words, the expected EPS after interest expenses is not smaller than the pseudo EPS. Okay, now the second test we did is to see whether our baseline result is driven by the EPS friendly cash. So here what we do is to break up the dependent variable into 2 dummy indicators. The first one is the dummy of EPS friendly cash, and second is the unfriendly cash. And we find that this discontinuity is driven by the EPS friendly cash payments. Okay, now there can also be other types of costs with the cash payments. For instance, as mentioned before, there could be additional tax liabilities and other distortions with firms' financial and investment policies and so on and so forth. So that when the firm is structuring the deal, it is possible that they choose to pay a combination of cash and stock instead of paying the entire deal in cash. So the trade-off would be the benefit of having an EPS accretion and the cost of paying cash. So we examine this intuition using a subset of the mixed deals. So if the trade-off is really at play, we would expect that the expected EPS after the deal is completed should be about the level of the acquired EPS before the deal, not too low below it, but also not too high above it. Okay, so in this figure, what we are plotting is these mixed deals expected change in EPS against the pseudo change in EPS. As we can see that on the negative side of the pseudo change in EPS, the expected change in EPS is exactly about the 0 level. So this confirms our argument that there is a trade-off over there. The acquirers do not want to pay the entire deal in cash and having a deep accretion. Okay, now after establishing our main results, how do we explain it? So we think our result is best explained by a so-called dilution mitigation effect, which means that the firms tend to choose the EPS-friendly method of payment, conditional on finding a suitable target. So this argument does not imply any distortion in the process of matching between the acquired and potential targets, but it can imply this kind of distortion. That is, if the EPS-friendly method of payment, which is cash usually, is not available, the acquirer might choose to forego a merger deal, even though there is positive synergy. Okay, now we argue that so there is another form of EPS sensitivity which has been widely discussed in the context of the merger wave in late 1990s. Which is called the EPS bootstrapping effect. It says that if a acquirer has a high PE, it can buy a low PE target with stock swaps so that it can achieve a mechanical boost up in EPS. So we find that our result is unlikely explained by EPS bootstrapping effect because our result is stronger after 2000. But the bootstrapping effect is more likely to take place when the stock valuation is high, so that it should be more likely to happen during the 1990s. Thanks. Okay. Now we also examine the channel of our effect. So we argue that managers, when they structure the deal, they are sensitive to EPS because they care about shareholders' perception about the deal value implication to them, especially when a voting approval is required on the acquired side. So to test this conjecture, we borrow a test from this paper, Li Liu and Wu, where they find that the firms, the acquired tend to avoid voting because voting will be required when the share issuance exceeds 20% of the acquired shares outstanding. So that when it's about to exceed this threshold, firms tend to substitute stock with cash payments. We confirmed their finding using our pseudo exchange measure. And moreover, we find that this effect is concentrated among the pseudo-dilutive deals rather than the pseudo-accretive or neutral deals. So this suggests that it seems managers tend to consider EPS dilution as a drawback of the deal. And this kind of drawback, they consider this kind of drawback as if it might lead to a voting rejection. Okay. Now, let me take the last, I guess, 3 to 4 minutes to show you the some results on the additional cost of EPS sensitivity in merger decisions. The first one is that we find financial constrained acquirers are less capable to use cash to mitigate the EPS dilution effect. So if we split the sample according to the acquirer's financial constraint level, we find our discontinuity result is concentrated among the unconstrained firms. So this implies that for a financial constrained acquirer, it might not be able to use cash to avoid the EPS dilution, so that if they really care, if they really worry about dilution, they may have to walk away from the deal. Now, secondly, we also checked whether EPS sensitivity has distorted the acquirer's financial and investment decisions. We find that before announcing a merger, that is paid in cash, and also the cash is likely driven by EPS concern, the acquirer tend to reserve their financial capacity before announcing such a deal by increasing their cash holdings and reducing external issuance. Moreover, we also find that they tend to cut investment before announcing such a deal. So this suggests that EPS sensitivity can lead to additional distortions to the acquirer. Last, we checked the stock returns of the acquirer and the target. We used the cumulative abnormal return from 42 trading days before the announcement and to deal completion. And here is what we find. We find that conditional on the deal being pseudo-dilutive, if the deal is paid in stock rather than cash, the acquirer's CAR is significantly more positive, while the target's CAR is significantly more negative. So we believe this is consistent with the following argument. If a pseudo-dilutive deal has to be paid in stock in the end, then that means it will become actual dilution. The acquirer will have to bear with whatever additional cost of having a EPS dilution, so that when they were doing the deal, they might require for compensation on that. They might require to pay a relatively lower acquisition premium. And this is consistent with what we find. However, if the pseudo-dilutive deal is actually paid with cash, it's less likely to incur any real EPS dilution, so that there's no need to require this kind of compensation. Okay, so that's all about our paper. So just to conclude very quickly, the main takeaway of our paper is that merger decisions are very sensitive to the mechanical EPS effects. And the paying cash is usually more friendly to EPS than stock. And moreover, we find that the need to finance the cash for EPS reasons incurs additional economic costs. Okay, so thank you very much for listening, and we very much look forward to the discussion.